Okay, one-time only special orders. Let's take a look at a scenario and set this problem up for a decision. Basically what we have is a company that needs to make a decision on whether or not to sell to a customer. So accepting or rejecting this special order is typically needing to be analyzed based on whether or not our operating income is going to increase. Now, this is one of those circumstances where sometimes some people do not look deep enough at the situation and therefore make the wrong decision. You guys understand this data better than some of the people that you might be working with in your future capacities. So make sure that you aid them in looking at all of the relevant and therefore discarding the irrelevant information. All right, so if we have sufficient capacity to produce some extra product or extra service and our costs are less than the revenues we could receive for those, then we should accept the special order if we know it's not going to affect our future revenues from our regular customers. We have to be careful with these. So accepting or rejecting a special order when there is idle production capacity and the special orders have no long-run implications is what we're talking about. Idle production capacity basically means you have excess capacity. You have extra available machine time, employee time. You can get the materials, etc., to do the job. You've got excess capacity and you can make it happen if it's in your favor. So our decision rule is based on, does the special order, if accepted, generate additional operating income? What is the effect on our bottom line? If it's positive or an increased operating income, good, let's accept it. If not, let's reject it. So again, we're comparing relevant revenues and relevant costs and making a decision as to whether or not our profitability has increased. All right, so we've got this particular company. It's in the 15th edition textbook. Their name is Surf Gear. They manufacture towels. They currently can produce up to 45,000 towels in a given month based on the capacity of their plant, the square footage they've got, the machinery they have, the employees that they've got. They can produce 45,000. But they are currently only producing and selling 30,000. So they've got excess or idle capacity to the tune of 15,000 units in a month. They get an offer from a customer or a potential customer. Okay, 5,000 units at $11 a piece is what this other company wants to buy these towels for. $11 a unit compared to the normal selling price of $20 per unit. We, of course, have those assumptions. We're going to assume, if we are not told otherwise, that our regular customers are not going to get wind of this. They are not going to be affected. They are not going to want the $11 per unit price. Okay? If we were, however, told otherwise, that it would affect our future sales, then we would need to consider that reduction in revenues going forward. But if we have an assumption that says, no, it's not going to affect our future revenues from our regular customers, then we just ignore that part. Cost of production, we know we've got variable cost and we know we have fixed cost. Now, on their face, what do we have? We've got direct materials of $6 per unit. We have direct labor, 50 cents per unit. And we have variable manufacturing overhead at $1 per unit. If you add all that up, it's $7.50 per unit. Our fixed cost can be broken out. We have $1.50 in fixed labor, and we have $3 in fixed manufacturing overhead. If you total that up, it's $4.50 per unit. But I want to refresh your memory that breaking down some of these costs on a per unit basis is where some people make a mistake. Okay, so be very careful, and you need to think about the underlying complications and what needs to be used and what does not need to be used. Let's look at the fixed cost per unit. If we have $135,000 in fixed cost, we can take that and break that down into a per unit. And we are going to do that using our regular production of 30,000 units to get us the $4.50 each. But ladies and gentlemen, this is our regular capacity, our regular production. We are saying that our regular capacity, our regular production covers that $135,000. We are not going to have to buy, under our scenario, any additional capacity. We're not going to get some additional property, plant, and equipment. We are not going to hire some additional supervisors. We're not going to pay additional property taxes either. Those kinds of things. All right, so be careful what numbers you're picking and what numbers you're ignoring. If you looked at it on a variable cost per unit plus a fixed cost per unit just in the manufacturing cost, you're looking at $12 per unit to manufacture. But again, remember what I just said. $4.50 each in fixed costs, but those fixed costs are being covered already by the other 30,000. This next additional 5,000, we're not going to have to incur more fixed cost. Okay, so we would really just need to be looking at the variable cost. So if we didn't know what we were doing and we saw this offer for $11 versus our cost to manufacture calculated this way, we would tell the people no, because we would supposedly lose $1 if we accepted this order. But that's why we're taking this class, so we can make sure that we can analyze this information further and make the correct decision. We may have some additional information regarding costs that also need to be considered. In this particular one in the text, they are saying that we've got some variable marketing cost of $150,000 and $60,000 that's fixed. And they tell us specifically that that $150,000 variable marketing cost is directly related to the original 30,000 units. We have no variable cost in addition to manufacturing variable cost for these extra 5,000. If we did, we would need to consider them. For example, if we had to pay salespeople a commission on these 5,000 units we're looking at accepting, we would need to consider that as a cost. What if we had to pay shipping and handling for those 5,000 extra units in addition to our variable cost? We would need to consider that shipping and handling as a cost or expense in our scenario analysis. So again, be careful. If you broke down those marketing costs on a variable cost per unit and a fixed cost per unit, you could do it. But again, those items are in relation to the 30,000. They have no relationship with the 5,000 units that we're looking at, okay? If we didn't know what we were doing and we took the original $12 cost to manufacture and added this additional $7 per unit in marketing cost, we would say, absolutely not. We do not want this order. They're offering us 11 and it cost us 19 to produce. That's where that management person would be making a mistake. Okay, so be prepared to spell this out for them and help them make the correct decision. All right, so let's take a look at really setting up the problem correctly. Do we want to reject it or accept it? Again, somebody would look at this on its face if they didn't know what they were doing, and they would say, reject it. 11 is not enough. 11 is so much cheaper than the 19 and a little bit cheaper than the 12. We would not make any money, but they'd be making the wrong decision. Right? Look harder at the numbers. Without the special order, we would still continue to sell our 30,000 units at $20 a piece, which would give us $600,000 in revenues. But if we did accept the order, what would our revenues be? We would have this original $600,000 because again, we've got that assumption that it's not going to affect our other revenues whatsoever under this particular one. And we would sell those 5,000 units at $11 a piece, which would give us an additional $55,000 in revenues. So if we accept, it would be $655,000 in revenues. If we rejected, it would be $600,000. Okay? Is this revenues of $655,000 greater than $600,000? Yes, it is, by $55,000. This is where you guys need to step back and make sure you're looking at things correctly. Revenues are a good thing. If the revenues here are greater than the revenues here, yay for us. Operating income would be affected by that to the tune of $55,000 for the difference. And because this one is greater, then it would be a positive result. Going and looking at our manufacturing cost, we said that it was our direct materials plus our direct labor plus our variable manufacturing overhead gave us a sure $750 that we absolutely have to cover. $750 times the original 30,000 units would be $225,000 in variable cost. But if we add on an additional 5,000 units for a total of 35,000 units, 35,000 times 750 equals this $262,500. $262,500 as a cost item is more expensive than the $225,000. Therefore, we've got a $37,500 result. But keep in mind, people, that reduces operating income by $37,500. Okay? Our marketing cost would remain the same. Here, they're still plotting it out in the textbook. Recall that I said we could leave this just off of here. We could just totally eliminate the marketing line in all reality because they don't differ among the alternatives. Notice the end result over here is a 0. But they're leaving it and showing it out here in all its glory. This $150,000 is being covered by the regular 30,000 units. Notice that we did not take the $5 per unit that somebody calculated and multiplied out times the whole 35,000 units. No, we are not doing that under this particular scenario. It is not an additional cost that has to be covered. If it was, for example, like I said, the selling commission or the shipping cost, then yes, we would have to cover that and we would need to multiply it out and show that as an additional cost line item. But here under this one, we don't. We can see that our revenues minus our variable cost equals our contribution margin. And of course, this is a positive number because our revenues are greater than our expenses, giving us a positive $17,500. We do still need to consider our fixed cost. What if we did have to spend additional in order to do those additional 5,000? Then we would need to make sure under the alternatives that we show those differing numbers. But again, the fixed cost, the manufacturing fixed cost, and the marketing fixed cost, those remain the same. There was nothing about our scenario that said we needed to increase those in any way, shape, or form in order to facilitate this special order. We really could have left these completely off because they're irrelevant. They didn't change under the scenario. Notice how they've got zeros over here. All right, so our net result at the bottom is that our operating income would in fact increase, which is a good thing, by the tune of $17,500, which is the difference between the operating income result for accepting the special order, which gave us a result of $47,500, and that's the difference between the extra revenues and the extra cost. Okay, incremental revenues, incremental cost. Increase operating income of $47,500 over what we would have expected to make if we rejected it. Okay, so under this right here, management should say yes. We accept your order at $11 per unit. Now you guys need to be sure that you're aware that you can run into potential problems. You've got to be careful. Managers should avoid 2 potential problems in relevant cost analysis. We've got to be careful. Avoid incorrect general assumptions that all variable costs are relevant. We saw just a moment ago that the variable marketing cost under this particular company's issues was not relevant. Okay? Sometimes they're relevant, sometimes they're not. So be careful. And then fixed costs. Here in our particular scenario, our fixed costs were irrelevant. They didn't change between accepting and rejecting. But you guys could run into scenarios later where fixed costs would actually change if we needed to accept that $5,000 order. You might have some additional fixed costs that would be incurred. And if so, you better make sure you cover it in your analysis. Be aware that unit fixed cost data can potentially mislead managers in two ways, and we have spelled that out and seen it. Unit fixed cost data can be misleading because fixed cost per unit may include costs that are irrelevant to a particular decision or may be irrelevant in total. And unit fixed costs are accurate only for that particular level of output. Recall, guys, I showed you that we took that $135,000 and divided it by 30,000 units to get the 450 or whatever our result was. That was based on 30,000 units. If we did 45,000 units in the month, that number would be way cheaper per unit. What if it was 25,000? It would be way more than 450 per unit. Okay, so that is affected by the denominator. Okay, so for this reason, managers often use total fixed costs rather than looking at that per unit data, especially when the output levels are a variable for a particular decision.